markets are getting absolutely clobbered, but everything is proceeding exactly as DeepMMT foresaw. That's what we'll be discussing tonight. We're going to talk markets. We're going to talk the DeepMMT, that's the deep learning model that is created on the foundation and theory of modern monetary theory that I use to forecast markets. We're going to discuss that model, its forecast that I posted on X all the way back in April. Yeah, we're going to cover it all, markets, the tools, everything, and where we are likely headed into the future. First, though, just to kind of set the stage, back in April 15th, I made this post right here on Twitter, X, and one of the things I like to do with the models I build is from time to time, every few months, give a little taste of where they are at, just to keep things honest. So there is a timestamp, and I can't do any shenanigans with a backtest or anything. So here's what I posted back in April in terms of where I thought markets, or at least where the forecast the DeepMMT had, thought where markets would be over the next 6 months. And again, you can see the timestamp. And if you want to go to this post, I'll link it below. I have about a year and a half's worth of history of DeepMMT and the track record that you can take a look at going further back. But again, April 15th, we go ahead and make this post, and I'll go ahead and zoom in on what the forecast looked like. Now, again, if you remember, back in April, we were just starting some heavy selling that lasted for about a couple weeks, 3-4 weeks into April, ultimately bottoming out at the end of April, and then we had a moonshot into where we are at now, well, where we were at a week or two ago before the heavy selling started. And that is exactly what DeepMMT at the time was looking for, heavy selling into the end of April, and then a rally into the end of July. And just to confirm what the actual ended up being, this is how things played out since then. And so once again, DeepMMT really showing that it has figured something out in terms of what drives markets. Now, one of the biggest questions I get is, okay, really neat tool, Doug, very accurate. How do you use this? How do you implement this? Obviously, it's not perfect at all times. What do you do when maybe you're in disagreement with where the forecast is at? Well, that's what I'm going to go over and piece together the entire argument I was making for all the subscribers over at Applied MMT on why I was getting into cash heading into this moment in time right now. So that is what we are going to cover in tonight's update. So what we need to do is we just need to first kind of get a frame of reference for how we look at markets. What I mean by that is, what is your time horizon and how do you view outcomes based on that time horizon? Well, DeepMMT, I would say, for me, narrows in on some of the shortest time frame that I know that I will be trying to trade. So before I get to where the forecast of DeepMMT is coming from, I want to know, and I have other tools that we have built, I want to know where the broader market outlook is at and what sort of selling should I expect. I'll explain what all that means as we go along, but the first thing that I do is, again, all the tools I'm going to go over tonight are available at appliedmmt.com. I go over to our dashboard, and the broadest measure of kind of market flows from this MMT perspective that we have as it pertains to where returns are likely going to be is the MMT Minsky flow phase classification model. Now, what this is doing is this is looking at flows all at a monthly and weekly sequence and saying, okay, based on where the core drivers are at, based on where the core flows are at, what is the likely quartile of forward returns 9 months forward of the S&P 500? And right now, the flow phase classification model is saying we are in phase 4, or the most bullish phase of forward market returns. If that was confusing, don't worry. Let's step through this step by step in terms of what this is looking at. According to kind of the core MMT theory, the business cycle works like this. You get a big, strong surge of government spending that capitalizes the financial sector. The financial sector then kicks off its own credit cycle, which drives business activity. And as the ebbs and flows of the cycle play out, eventually you get yourself pretty darn close to some sort of surplus on the deficit spending side. You get some sort of kind of Minsky acceleration of credit expansion, and then eventually you get to this point in time where you are at an acceleration of credit and in an effective surplus for deficit spending, and that is where crises emerge. And you can take a look at the chart that's in front of you and see that this is exactly what played out from at least the deficit side. We'll look at the bank credit in just a second, but from the deficit side, certainly each recession or major sell-off happens as the rate of change of deficit spending either goes negative, so we're in surplus territory, or decelerates at a very tremendous amount. So back in the 70s, that explains the 70s era that we had. 91 recession right here, obviously the dot-com bubble. As we were heading into 2000, the great financial crisis, and then more recently, the 2022 bear market that we had, all happened in conjunction with deficit spending going negative, so becoming a surplus. The next thing you need to look at, though, is you want to see a sudden acceleration of bank credit into that point. That is the necessary mechanics of the boom and bust cycle. It is the acceleration that causes the instability, and then the collapse with a vacuum of deficit spending where it just eliminates any possibility for income until the automatic stabilizers kick in. And that is exactly what we see before every major recession. Again, just zooming in to say 2000, big acceleration, 2008, very strong acceleration into the great financial crisis, and then 2022, more recently, we had a strong acceleration following the COVID stimulus, which kicked off a short credit cycle. So consistently, this is what explains major sell-offs in markets. So what you can do then is if you plot those elements in dimensional space, you can see where we are at relative to the flows. So what I have up on the screen right now is the plotting of three things. On the x-axis, it's the private debt to GDP ratio. This is one additional thing I'm going to add to the two things we just talked about. On the y-axis, that's going to be the government spending. So as you can see, major surpluses in 2000, 2022, and the great financial crisis. And then on the z-axis, that is going to be your private credit. So you can see as we push higher, that is where the crises emerge. Again, all in line with heterodox MMT type theory in terms of what drives the business cycle. So as we place this in space and in three-dimensional space, what we end up seeing is we can see where the cycle pivots at and what the forward returns of the S&P are. And that is what the color coding is, what the 9-month forward returns are at each moment in time. And then we can see that, yeah, every time we get into a major a major surplus scenario, so 2000, 2008, 2022, and we come off a recent peak in the credit cycle. So again, this is our credit cycle axis that we're looking at now. Each time we come off that peak, that is when we are going to see, crises emerge. Now, why do I add that private debt to GDP ratio? Well, the higher private debt to GDP ratio we have, so the higher credit is in terms of the overall growth, the higher the likelihood that the crisis that emerges will be a severe crisis. So when we had the 2022 bear market, we had quite a reduction over the last 10, 15 years of private debt, and therefore the overall risk to major crisis was much more minimal because of that reduction. Likely, by the time we get to the next crisis, we will surpass the 2008 level, and we might end up facing a deeper crisis. We'll figure that out. We'll solve that when we get there, but it's likely far off into the future. So what this is all saying is we can create a model that understands where we are in this space and then correlate it effectively with the sort of forward return expectations given the historical nature of these flows. And that is exactly what this model is saying. What it's saying is, in that three-dimensional space, we are in the most bullish outcome of that space. And it makes sense. Why? Because if we look at where deficit spending is at, even though we've come down quite a lot from the initial surge following the 2022 rate hikes, we're still above average or in a very healthy spot for deficit spending. We're definitely not in the space where you would expect crises to emerge. And then if you look at where bank credit is at, we are just starting the acceleration phase. We are in the infant stage of the credit cycle. And really, not only are we in the infant stage of the credit cycle, but we're in a kind of a new era of still very strong deficit spending with a credit cycle kicking off into a rate hike cycle, which to me just adds up to what will likely be a very strong credit cycle for some time to come. So everything looking very strong in our flow phase classification model is saying, yeah, we're in a bullish market. So, Doug, we're in this bullish market. Why did DeepMMT think a big sell-off was about to happen? Well, again, as I said, we need to understand what time horizon we are looking at. At the longest time horizon, things are looking bullish, but even in bullish markets, you can still get deep pullbacks to occur. And that is where we need to zoom on in a little bit more. At this point, what I want to pull up is our fiscal flow sentiment ratio. So what is this? Well, from time to time, the ebbs and flows of the main driver, that fiscal flow, will give way. There are tax strains that occur. We had one in June, we had one in April, and the kind of longer term trajectory of flows, which I'll pull up now, has just been lacking. We saw some major tax strains over the last couple months, and the overall pace here of fiscal flow. So I'm highlighting the purple line here, which is the smooth version of the 90-day average of the fiscal flow. We've seen since the April tax strain a steady decline in the overall flow, while markets continue to push higher. And so what the flow sentiment ratio does is it takes a look at the overall market sentiment and says, is this sentiment aligned with where flows are at, or is it misaligned with where flows are at? Consistently, the biggest moves, the moves that you really need to be afraid of, are not when sentiment is aligned with flows. It's when sentiment is misaligned with flows. And in fact, it was this time last year that we had a very similar reading, a very strong run up during the summer months, and then flows giving way because of the tax strains, and a very similar play where we end up getting this sell-off because of the overexuberance. We just need to reset. And you can see historically, we find these time periods. A good example is into September of 2018. Again, flows misaligned with sentiment. You can see them throughout the chart, where you need to be a little bit more concerned, and especially when it lasts for a while, it just builds up the misalignment, and that's where the big moves can happen. So I oftentimes tell my subscribers in the updates that I'm not concerned when flows are in alignment with sentiment or markets. That's fine. It's when you get a big divergence between the two. That's when we need to kind of wake up and say, okay, if the rest of our tools maybe call for, say, something like DeepMMT is calling for a sell-off, we need to be a little bit more cognizant. So all the way back in June, at the end of June, actually I made a video here on YouTube at the end of June saying, look, I think the stars are aligning for a bit of a pullback here, and we should start to expect just that. And of course, we are starting to see that play out. And so finally, as we narrow in on our time horizon, we can now bring back up that prediction of DeepMMT, see that it was starting to look for a top at this time frame, and look for a pullback. And once all the stars aligned and everything made sense, and we used all the tools that we had, it was becoming pretty apparent by the end of June that July would likely be a peak to markets for at least a little while here. So that is where we are at. But perma bears, be aware. I think this will be relatively short-lived. I do think we will set up for a buying opportunity. Maybe things get a little dicey here. Maybe we push deeper into past August, past September. It's a distinct possibility. Or maybe we get a very swift sell-off for the remainder of July into early August, and maybe we catch support by August. That remains to be seen. We'll see how markets respond. But when we look at the rest of our tools, what we're seeing is this is a realigning of market price relative to where flows have been, a readjustment of sentiment. We did get a small bounce in bearish sentiment, but far from the necessary reset to really flip our flow sentiment model into a more bullish stance. So we still need some selling to shake out here. Again, maybe it'll take a few more months for that selling to fully make its way in, to get all of our signals to be more bullish, or maybe it happens relatively quickly and a ton of fear enters markets right away. Suffice to say, though, overall, we are still in a spot where long-term, I expect markets to recover in a bullish outcome to come out of this. But in the short run, we were definitely overdue as we headed into July, and by the end of July here, for a deeper sell-off. And I think we are finally seeing that. And again, exactly as DeepMMT thought we would at this point. So that is the toolkit. That is how I use DeepMMT in conjunction with everything else. And again, all the tools are available over at appliedmmt.com. If you're an active trader, active investor, make sure you check out the site. Other than that, that's what I have for tonight. As always, get subscribed, hit the like button if you found this video particularly helpful, and turn that notification bell on so you won't miss any updates going further. If you have any other questions, drop them below as well. Maybe I'll do another video like this where I respond directly to some questions. All right, that's all I've got for tonight. Until next time, good trading, everyone, and we'll see you then. Bye-bye.